Hey guys, welcome to the video. In this video, we're going to show you how to use a really simple calculation that helps you understand the amount of time it'll take to double your investments. So we're going to introduce you to the rule of 72. We're going to tell you what that rule is. We'll give you some examples on how to use this rule with your life. And then at the end, we're going to show you how many times you could expect to double your money over the course of your life by using this rule. So why don't we get started and start understanding what the rule of 72 is. So the rule of 72 is simply a calculation you can use to understand for any investment that you have, the amount of time it'll take to double your money. So if you have $1,000, the amount of time it'll take to get to $2,000. It's really helpful because it basically helps you convert that percent of annual return or percent of income into a really clear and easy to understand number that gives you context and the ability to compare investments. So what I love about this tool is it helps you bring context. It helps bring context to the annual rate of return and put it in numbers that anyone can understand regardless of their financial background. So all it simply is you can take the number 72 divided by the annual rate of return, and that will approximately tell you the number of years that it takes to double your money. So now that you guys have a pretty good idea of what the rule of 72 is, let's give 3 quick examples on the next slide. So for our example, we're going to use 3 really common investment vehicles that people across the planet use. But before we calculate the rule of 72, we have to start with what is the rate of return. So the 3 vehicles we're going to use, the first one is Wells Fargo. And this is simply, think of it as your standard low interest savings account. The second example is a high yield savings account. So one great thing about the internet is there's tons of high interest, high yield savings accounts that are popping up across the country, and Ally is one of the leaders, so we're going to use them as our example. And then what we're going to do is we're going to compare that against the S&P 500. And all the S&P 500 is it's simply the 500 biggest companies in America. It's basically a blend of those companies. So think of it as a big piece of the entire American stock exchange. And let's just quickly walk through the rate of return. So you can see this is really common online, but Wells Fargo and other low interest savings accounts, they provide a 0.1% rate of return on average per year. Ally today is providing about a 0.5%. And then if you look at the last 50 years of the S&P 500, they've produced approximately an 8% rate of return. So the challenge that we have here is we really don't understand the impact of these different numbers. Like, we all know that a higher percent is better, but we can't really contextualize that and understand what impact will that have on our life, or what does that really mean? Like, is the difference between 8% and 0.5% big, or how big would that be for our life if we decided to invest in the stock market versus keeping all of our money in savings? So this is exactly why the rule of 72 is helpful, is because we can convert these rate of returns into easy napkin math that anyone can understand. So why don't we go ahead and do that? So if we take those rate of returns and then use the rule of 72, we can easily convert those percentages into the number of years it'll take to double our money. So as an example, if we just put $1,000 in Wells Fargo, it would take 7,200 years in that savings account to double our money, which is a really long time. Then if we compare that to a high yield savings account at Ally, it'll take 144 years. That's really a long time, but it's a lot better than 7,000 years. And then finally, if we compare that against the interest rate or the rate of return of the S&P 500, it takes 9 years. So really the intent of the rule of 72 is to understand what these percentages mean and to put them in context of your life. So you can see that there's a huge difference in interest rates. Now that we have an idea on how to use the rule of 72 and how to use that to compare investments, I want to quickly pause and explain the difference between a high yield savings account and the S&P 500. So when you invest in an online savings account, your money will always reliably go up each month or each year. But when you invest in the S&P 500, the stocks go up and down. So some years you might make 35%, some years you might lose 25%, but most years you'll probably make a little bit of money. So we're speaking about strictly averages here. So before I show the next slide, I just want to add that by investing in stocks, there is a higher risk and you do expect a higher return because you're taking that risk. So now let's take the rule of 72 and apply it to a real life example. So let's say you're a 25-year-old and you spend $1,000 and invest that in the S&P 500. How much money would you have by the time you're 75? So the rule of 72 helps us understand how that money will double over time and how that doubling compounds. So if the S&P 500 continued to produce an 8% annual rate of return, that 25-year-old, by the time they're 75, that $1,000 investment will be worth $50,000. So it will nearly 50x over the course of a lifetime. So this is really the power of this rule. It helps you understand how your money will change over time and how you can use the rule of 72 to basically understand investments, understand interest rates, and understand as they change what they do to your life in the future. Thank you for watching this video. I hope this type of content is helping you learn personal finance and finance skills in really easy to understand ways. This is a new channel, so every like, subscription, and comment makes a really big difference. So if you could, please do one of those three things, and thank you very much. I'll post another video next week.